You are welcome to Advanced Tax Professional Level Online in Equity. My name is Tunde Idris. So I believe some of you will have seen me physically when you are doing a physical lecture in any of our center. So I will be the one to spare the class with Mr. Chris. Mr. Chris was around yesterday. He was the one that took the lecture basis period yesterday. Yes. So today, being the first day of the lecture, we will do just introduction about tax. We cannot just go to advanced tax straight without doing introduction. I believe that some of us will have know much about taxation at the skill level. But according to our syllabus, we have to introduce tax before we go to advanced tax. So sometimes even in the advanced level, question about 10 mark normally come from introduction to tax. Sometimes 15 mark. So that is the reason why we will start today, being the first day of the lecture. We have to start with introduction to taxation. We need to understand what is taxation. That is where we start today. So we start with definition of tax. What is tax? As we all know, tax is a compulsory levy imposed by government on its citizen for economic growth and development. Tax is a compulsory levy. That one means it's something that is compulsory. Tax will be compulsory on those who are earning income. Those who are receiving income, who are deriving income, that means once you are earning an income, you must pay tax. And who collect tax? The government. It is imposed by government. On who? On the citizen, the citizen of the country. So far as you are an income earner, that means you will pay tax. Why do we collect tax? For economic growth and development. So that is the clear definition of tax. So apart from definition of tax, we need to define what is taxation. Taxation means the steps, the method used by government in collecting tax. The system, method, process adopted by the government in collecting tax. That is taxation. Now, we can look at objective of taxation. Objective of taxation. So by the end of this lecture, by God's grace tomorrow, I will send my own course outline, the area that I'm going to discuss for this diet. I will send it so that we will normally look at it so that we can use it as part of evaluation where we have taught, where we have touched, where we have not discussed. So we can use that to review our performance. So at the end of the lecture, either today or tomorrow, I will send it. So objective of taxation or purpose of taxation or the reason why government collect tax. What are the objective of taxation? What are the purpose of taxation? What are the reason why government collect tax? We need to look at that. Is the next thing that we need to look at. First and foremost, government collect tax to generate revenue for government. Number one objective, which is the primary objective of taxation, is to generate revenue for government. Tax generate revenue for government. Tax serve as a means of revenue generation. It generates revenue for government. Government, without revenue generation, government cannot carry out their function. One of their function is to provide security, to provide basic amenity like construction of road, adequate healthcare service, all these function, building of schools, all these function of the government. Government cannot carry out the function without revenue. So revenue is very key. government have to generate revenue, and the only means of revenue generation by government, one of the means of revenue generation by government is through taxation. Another objective of taxation is what? Redistribution of income and wealth. Government can use tax to redistribute income and wealth. What does that mean? It means government will collect tax from the high income earner, and they will use this tax to develop the rural area, the area that the lower income earner are residing, so that the gap between the rich and the poor is going to be reduced to some extent. You understand? Redistribution of income and wealth means you are taxing the high income earner for the benefit of the lower income earner, so that the tax you collected from where the higher income earner are residing, like Victoria Island, Lekki, Ikoyi, when you collect tax from those areas, you can use the tax to develop some rural area or some urban area residing by the lower income earner, like Ikorodu, Yanopaja, some of those areas, so that the gap between the rich and the poor is going to reduce to the barest minimum. So redistribution of income and wealth is part of the objective of taxation. Another objective of taxation, management of the economy. We use tax to manage the economy. What does that mean? Tax is one of the tools of fiscal policy. We have different tools of fiscal policy. One of them is taxation. Another one is subsidies. Another one is price control. Another one is expenditures. So one of the tools of fiscal policy is taxation. When we are in the economic boom, we have much of money in circulation. Government can increase the rate of tax so that to control the economy. But in the situation of the economic recession and there is high level of inflation, what government can do to stabilize that present situation is to reduce tax or give tax rebate to manufacturer, so that the price of goods and services will be reduced. Another objective of taxation is harmonization of economic objective. This is one of the objectives of taxation. Taxation used to harmonize economic objective by ensuring that our economic objective is in line with the guideline stipulated by ECOWAS, is in line with the guideline stipulated by IMF, is in line with the guideline stipulated by World Bank. So it's part of objective of taxation. Another objective of taxation is to protect domestic industry. Domestic industry simply means local industry. Those industries that are located within the country and is owned by the indigenous, the national of the country, is owned by the citizen of the country. It's an indigenous company. We need to protect them against the multinational company. We need to protect them against the foreign country. One of the means of protecting them is through the introduction of taxation. How? Most of those products produced by this domestic industry, once we have the imported product, we have the imported of that, once such kind of product, there are some companies that normally import it to Nigeria. We can increase the import tariff so that people will not patronize the imported product. They will be patronizing the local products, so that it will create economy. Those who are the domestic industry will have impact in the economy by creating more employment opportunity to the citizen. to the citizen by contributing to our gross domestic product. So government can reduce importation through the increase of import tariff on such products that we have some manufacturer producing them in Nigeria. So to protect domestic industry is one of the objectives of taxation. See, apart from the one I have in this my material, there is another objective of taxation which is not stated here, to discourage consumption of harmful goods. Tax can be used to discourage consumption of harmful goods. There are some goods, they are harmful to our health. Example of such goods are tobacco, alcohol. Even for those who are selling the tobacco, they will say, the smoker are liable to die young. We know it's very dangerous, but government cannot sell, the manufacturer or the producer should not sell it, because government too is collecting tax from them. What government will tell them is, please try to caution the consumer. And second thing that government will do is, if government want to discourage people from smoking cigarettes, government should increase the tax, or government should introduce special tax on cigarettes, so that the prices of cigarette or alcohol is going to increase. When the prices is increased, it will make some people not to patronize it. It will discourage them from consuming. Apart from that, somebody consuming like 5 packets of cigarettes in a day may decide to be consuming 1 packet of cigarette because the price is expensive. It will reduce the rate of consumption because government introduced government sanction special tax on such kind of dangerous products. So to discourage consumption of harmful goods is part of objective of taxation. Another objective of taxation, which is not mentioned here, is to protect local currency. We can use tax to protect local currency against foreign currency. How? Government can make a law that any trading, any business, commercial transaction that is being carried out using foreign currency is going to attract a special levy. By virtue of that, that will discourage most of people sourcing for dollar, sourcing for pounds, because they know that they are going to pay every tax. So as a result of that, it will make our local currency, naira, to have value against foreign currency. So to protect local currency is one of the reasons for taxation. So we have mentioned objective of taxation. Now let's look at sources of taxation law. Because tax is law. Everything we practice in tax is coming from the law. We have tax law. So where do we get the law that regulates tax? That is what we want to look at now. Sources of taxation law. Let's look at sources of tax law. Number 1 sources is the Constitution. The Constitution of 1999. Some section of the Constitution stated categorically the revenue, the taxes and levy that will be collected by each tiers of government. The approved taxes and levy that are to be collected by each tiers of government. So in the 1999 Constitution, it was stated clearly the kind of taxes and levy federal government can collect, the kind of taxes and levy state government can collect, the kind of taxes and levies local government can collect. So the primary sources of tax law is Constitution. So many sections in this Constitution mention the issue that relate to tax. Another sources of tax law is statutory sources. Statutory sources. Statutory sources. Statutory sources, they are the law that pass through the national law that was approved by the National Assembly. that are specifically designed for tax. Example of such law is Personal Income Tax Law, Personal Income Tax Act, Company Income Tax Act, Capital Gain Tax Act, Value Added Tax Act, Finance Act, Finance Act 2021, Finance Act 2020, Finance Act 2023, Tax Reform Act, Withholding Tax Regulation. They are statutory sources of tax law. All these laws are approved by the legislative arms of government. We have case law. Case law. Case law, they are the law that guide tax that emanate as a result of dispute between the taxpayer and the tax authority. Maybe the taxpayer and tax authority has dispute as regards to assessment given to the taxpayer. Taxpayer can approach the court. Once taxpayer approach the court, court will make judgment. At the end of the day, the final judgment made by the Supreme Court or any other court, and it is not contested by any party, will become a judiciary precedent. So such judgment is a case law. Example of that, I remember a case between Shell Petroleum Development Company versus FRS. Shell Petroleum Development Company versus FRS. The case between Shell Petroleum Development Company versus FRS is one of the reasons why we have a Petroleum Industrial Act, PIA. There is another case too, a particular school in Lagos, one of the big schools in Lagos State. They took FRS to court. Such case, that school was established in the 1976. And that particular school is one of the biggest school in Lagos, most expensive school in Lagos, private school. They took FRS to court. When in 2014 or 2012, FRS approached them that they should come and start paying tax. That school explained to FRS that they cannot pay tax, they cannot pay company income tax, they cannot pay education tax, they cannot pay any form of tax because they are registered as a company limited by guarantee. And you know, under Company Income Tax Act, any company is registered as a company limited by guarantee. That means that company is a charitable in nature. It's just like NGO. So once they register as a company limited by guarantee, they are not expected to pay tax. That particular school took FRS to court that they will not pay tax because FRS, at the end of the day, they summon them. The FRS give them assessment of provisional tax of 5 years in the last 5 years that they need to pay because they believe that their school is one of the most expensive schools and they are no more a charitable in nature, though they are established as a company limited by guarantee. Because when a company is registered as a limited by guarantee, that means they are just like NGO. They want to render charitable service. That particular school is still claiming that because it was stated in their object clause that they are charitable in nature, that they will not pay tax. So they took FRS to court. When tax authority or taxpayer want to go to court, the first court that will decide the case is Tax Appeal Tribunal. So that school took FRS to Tax Appeal Tribunal. From the Tax Appeal Tribunal look at the case. At the end of the day, the Tax Appeal Tribunal make a judgment that this school, you are no more a charitable organization, that you need to pay tax. You need to start paying tax because your school is one of the most expensive schools in Lagos. And by virtue of that, you call yourself a charitable organization. When you call yourself a charitable organization, what does that mean is that anybody can afford to go to your school and your school should be free of charge. But your school, in a town, people are paying like 5 million, 10 million as a school fees. Why do you now call yourself charitable organization? So that appeal tribunal make a judgment that FRS is right for giving them an assessment, and they should go and pay the assessment within 90 days. The school is not certified. That school, they are not certified with the judgment. They proceed further before the 90 days. They appeal the case. They proceed to Federal High Court. Federal High Court look at the case again. At the end of the day, same thing. Federal High Court said, this school, you are no more a charitable organization. Go and pay your staffs with FRS. FRS is right for giving you assessment. And then FRS give them, the total assessment given to them by FRS then was about 21 billion. So at the end of the day, the school proceed further that they cannot pay this tax. So they went to Court of Appeal. Court of Appeal look at the case too. They hear the two parties. After some time, Court of Appeal make judgment. The judgment was also in favor of FRS. That FRS is right for giving them assessment because they have go against their object clause, which they register as a company limited by guarantee. And they say they want to render charitable service. People that they want to render charitable service for them cannot afford their school fees. Their school fees is one of the most expensive school fees in Nigeria. Never relents. After the Court of Appeal, the school went further. Said, let Supreme Court decide. After Supreme Court, we'll leave everything to God. The school went further to Supreme Court. At the end of the day, Supreme Court look at the case. When Supreme Court look at the case, the way Supreme Court viewed the judgment is different from the way Appeal Court view it, the way Federal High Court view it, the way Tax Appeal Tribunal view it. At the end of the day, Supreme Court made final judgment, and the judgment was in favor of the school. That school win the case. What Supreme Court was saying then is that, FRS, you are right for giving this school assessment, but you cannot prove beyond reasonable doubt that this school have go against their object clause. Secondly, you are not the one that is right that will tell us that this school has go against their object clause. That responsibility, your own responsibility is to collect tax. If they have go against their object clause, it is CAC that register them, that will sanction them, that they have go against their object clause, not FRS. And by virtue of your section, the section of the company income tax, any company that is registered as a limited company by guarantee is not supposed to pay tax. So by virtue of that, this school cannot pay the tax. That was when the school won. When they make that judgment, other big school now use the judgment as a judiciary precedent. Some schools have started paying tax then. They have to stop that, since they register as a company limited by guarantee, they are not registered as a limited company, they will not pay tax. So FRS have to go to drawing board. They have to go and make amendment to that section of the company income tax that said, any company registered by guarantee should not pay tax. They have to go and make amendment. It's one of the first amendment that was made in the Finance Act 2019. So that is case law. Another sources of tax law is budget speech. Budget speech as a tax law is most common during the regime of military, during military regime. You know, in military regime, we don't have legislative arms. We have only executive arms. So the military regime, at the point of presentation of budget, they can make a speech, and that speech will become binding. And effective from that day, it has become a law. People will follow it. I remember when they want to introduce value-added tax in 1993, it was through budget speech that value-added tax was first introduced by the then head of state. It was that at the point of signing the budget, the head of state said there is now a new tax called value-added tax that is going to be paid on consumption of goods and services, and is at the rate of 5%. Henceforth, as from today, every good and services, some listed goods and services will attract VAT. It was after that budget speech they now passed VAT Act of 1993. But during the era we are now, we are in the era of democracy. We cannot have budget speech. President cannot just make a speech that we can now say it has become a law that we need to follow on task. No, that speech must have a legislative backing. So that is one of the sources of tax law. Another sources of tax law, customary law. Customary law. We know that tax has been in existence for over a long period. Tax is old. More than thousands of years. We have been practicing tax even before Jesus Christ was birthed. Even before the born of Jesus Christ, there is tax. Even before Prophet Muhammad was around, there is tax. They have been practicing tax for thousands of years. When we look at Nigeria's situation, in the olden days, the traditional ruler, they are the ones collecting tax. In Southwest, we call them Ishakole. They are the ones collecting tax from the citizen. Even in the Quran, there is zakat. That zakat is tax. Some section of the Bible even said, give Caesar to what belongs to Caesar. Is referring to tax. If I'm right. So, tax has been in existence for ages. Customary law. These are the sources of tax law. Now, let's look at classification of tax. Classification of taxation. Let's look at classification of taxation. How do we classify taxation? Number one classification we have is classification according to tax rate. Classification according to tax rate. Under the tax rate, we classify tax into three types. We have progressive tax, we have proportional tax, we have regressive tax. Progressive tax, proportional tax, and regressive tax. What is progressive tax? Progressive tax simply means the tax system where the rate of tax increase as income increases. As your income is going up, your rate of tax too is going up. Example of progressive tax, personal income tax is a progressive. If you look at the table of personal income tax computation, first 300,000 is going to be taxed at the rate of 7%. Second 300,000 is going to be taxed at the rate of 11%. Next 500,000 is going to be taxed at the rate of 15%. Next 500,000 is going to be taxed at the rate of 19%, followed by 1.6, 21%, while the last one is above 3.2, which is going to tax at the rate of 24%. You can see that it's progressing. As the income is going up, the rate of tax too is going up. In our secondary school days, when we define progressive, they will say progressive tax is a tax where the rich pay more than the poor. What does that mean? It means as you are getting more income, you are paying more tax. The next one is proportional tax. Proportional tax simply means a tax system where the tax rate remain the same despite changes in income level. Your tax rate remain the same despite changes in income level. Either your income is going up or your income is going down, you still pay the same rate of tax. Regressive tax. Regressive tax is a tax system where the tax rate decrease as your income is going up. As your income level increases, your tax rate decrease. That means progressive tax favor the higher income earner than the lower income earner. That is that. So that is classification according to incident. Classification according to incident. Let's look at another classification of tax. Classification according to, the first classification is according to tax rate. Second classification I want to look at now is classification according to incident. Classification according to incident. How do we classify tax according to incident? So let's look at that. So please, just give me 5 minutes. Let me arrange my laptop. So I want to share it through laptop. So please, let's go ahead while the laptop is loading. Classification according to incident is what we want to look at now. How do we classify tax according to incident? If you want to classify tax according to incidents, we have two types of tax: direct tax and indirect tax. Direct tax and indirect tax. Direct tax and indirect tax. What is direct tax? Direct tax, they are those taxes imposed on income of a taxpayer. Direct tax are the taxes imposed on income. They are the taxes imposed on income. Of a taxpayer. That taxpayer can be individual or company. So they are the taxes imposed on income or profit of a taxpayer. Type of direct tax. Under these direct tax, we have different types of tax. We have personal income tax, we have company income tax, we have capital gain tax, we have petroleum profit tax. Let's look at them one by one. Personal income tax. Those are the taxes imposed on income of individual, company. Personal income tax, they are the taxes imposed on income of individual, employee, sole proprietorship, partnership, trustee, community. Personal income tax is otherwise called pay as you earn. Personal income tax is otherwise called pay as you earn. It is collected on a monthly basis, 10th of the following month, and it is imposed or it is administered, collected by State Board of Internal Revenue. If you are employee, you are a sole proprietorship, you are partnership, you are trustee, you are community, you need to pay personal income tax once you derive income. From the salary of employee will pay personal income tax. From the profit of sole proprietorship or partnership, they will pay personal income tax. So personal income tax is collected by State Board of Internal Revenue Service. The next type of tax that we have is company income tax. Type of direct tax that we have is company income tax. What do we understand by company income tax? Those are the taxes imposed on the profit derived by company. It is imposed on the profit derived by company. And it is collected by Federal Inland Revenue Service. It is administered and collected by Federal Inland Revenue Service. That is company income tax. After company income tax, we have capital gain tax. Capital gain tax. What do we understand by capital gain tax? Capital gain tax, they are those taxes imposed on gain arising from disposal of fixed assets. Gain arising from disposal of tangible assets. That is capital gain tax. When you dispose an asset, when you make a gain, example, you buy a land 5 years ago, you buy the land 10 million naira in year 2020. You want to sell the land now, you now sell the land 50 million naira. The selling price is the sales proceed. The purchase price is the cost of acquisition. When you minus the cost of acquisition from that sales proceed, you have made a capital gain of 40 million. From that capital gain of 40 million, you are going to pay capital gain tax of at the rate of 10%. The rate of capital gain tax is at the rate of 10%. So you will pay capital gain tax on them. So that is capital gain tax. The question is, who collects capital gain tax? Who administer, collect capital gain tax? Which tax authority? The relevant tax authority for capital gain tax depends on the nature of the transaction. The relevant tax authority for capital gain tax depends on what? The nature of the transaction. If the person that made the gain is an individual, also proprietorship or partnership, the capital gain tax will be collected by State Board of Internal Revenue Service. But if the person that made the gain is a company, if the person that made the gain is a company, that means the capital gain tax is going to be collected by Federal Inland Revenue Service. That is it on capital gain tax. For this, our advanced tax, one of the major topics that we are going to solve that will take us 3 week lecture period is capital gain tax. Capital gain tax constitute 20% of our syllabus. 20% of our syllabus. So I'm the one that will take capital gain tax. So it contributes 20% of our syllabus. So I think in the next 3 weeks, we will start capital gain tax. And if you are familiar with the past question, if you study the past question very well, you will see that capital gain tax normally come out every diet for advanced tax. Capital gain tax normally come out every diet. So that is it on capital gain tax. Apart from capital gain tax, we have petroleum profit tax. It's another type of direct tax. Petroleum profit tax. Petroleum profit tax is a tax imposed on profit derived by upstream petroleum company. What are the upstream petroleum companies? Companies that deal with extraction, drilling, refinery of crude oil. Some kind of company, they will not pay capital gain, they will not pay company income tax, they will rather pay petroleum profit tax. According to Petroleum Industrial Act, petroleum profit tax is now called hydrocarbon tax. It's no more called petroleum profit tax. It's now called hydrocarbon tax. All the upstream company, Shell, Chevron, Mobil, they are the ones that pay petroleum company tax, petroleum profit tax. But all the downstream petroleum company, those companies that has a filling station, they will not pay petroleum profit tax. They will pay company income tax on their profits. Ladies and gentlemen, petroleum profit tax too constitute about 25% of our syllabus. Petroleum profit tax constitute about 25% of our syllabus. So in every diet, question must come out on petroleum profit tax, which is now called hydrocarbon tax. It's no more called petroleum profit tax. It's called hydrocarbon tax. So hydrocarbon tax is going to be taken by my colleague, Mr. Chris. So he's an expert in hydrocarbon tax. So it's one of his area of concentration. So he's very good in hydrocarbon tax. So it's about 25% of our syllabus. Capital gain tax, 20%. Hydrocarbon tax, 25%. So that means for you to go for an exam in advanced tax, you must understand capital gain tax and hydrocarbon tax very well. So it's very, very important. Capital gain tax and hydrocarbon tax, they are very important for our level. So still on direct tax, apart from petroleum profit tax, we have another type of tax called education tax. Another type of direct tax called education tax. Education tax. Another type of direct tax called education tax. Education tax, they are those taxes imposed on adjusted profit. It is imposed on adjusted profit. It is imposed on adjusted profit. And that adjusted profit that was imposed of every company, education tax is at the rate of 3% presently. The reason why they collect education tax is for rehabilitation, restoration, consolidation of tertiary institution. That education tax is being collected and administered by FRS. After FRS collect education tax, they will remit the education tax to a body called TET Fund. And that body called TET Fund, they will use the education tax to construct, build more classroom, lecture hall, lecture theater in the tertiary institution, public tertiary institution, public university, public polytechnic, and public college of education. The rate of education tax was changed to 3% by Finance Act 2023, which was effective in January 2024. So education tax as at year of assessment 2019 was 2%. Year of assessment 2020 was 2%. Year of assessment 2021 was 2%. Finance Act 2021 increased the rate of education tax to 2.5%. And you know that Finance Act 2021 effective date of commencement commenced in January 2022. So year of assessment 2022, education tax was 2.5%. Year of assessment 2023, education tax was 2.5%. As from year 2024 up to date, education tax rate is now 3%. Ladies and gentlemen, the reason why I'm showing you this, you may see a question that will ask you to compute tax liability for 5 years, and they have different year like this. The year of assessment given to you will be the one to determine what rate are you going to use for education tax. Assuming you are given 2015 year of assessment, what rate are you going to use for education tax? Assuming you are given 2015 year of assessment, what rate are you going to use for education tax?
2%.
2019.
2%. Yeah. But if you are given 2027 year of assessment, what rate are you going to use for education tax?
3%, sir.
3%.
So please, you need to be mindful of the year, especially 2022 and 2023. Those are the 2 years that have how many percent?
2.5%.
2.5%. Do you understand? Do you understand, sir? So we are still on direct tax. On direct tax, that is education tax. Let's move to another type of direct tax. Another type of direct tax we want to move to is technology tax. Technology tax. Technology tax is paid on 1% of your profit before tax, and it is paid for the purpose of development of information technologies in Nigeria. It is administered and collected by FRS too. But once FRS collect technology tax, they will remit it to a body called National Information Technology Development Agency. We call the body, the abbreviation of the body is called NICDA. They are the one responsible to manage the technology tax. FRS will collect the money, but at the end of the day, it will remit it to this body. This body, they are the one that develop anything that have to do with information technology in Nigeria. This technology tax, it is not every company that pay it. it is some selected company. Those specified companies that pay technology tax must fall under telecommunication, banks, insurance, internet service provider, payment service solution. That means a company like MTN under telecommunication, Glo, Airtel, they will pay technology tax. All the banks too pay technology tax. Insurance things too pay technology tax. Internet service providers too pay technology tax. Hello. Sorry for interruption. So on technology tax, we have explained technology tax. It's another type of direct tax that we are explaining. Aside that, we also have another type of direct tax called police development levy. Another type of direct tax called police development levy. Police development levy is another type of direct tax that we have. Police development levy. This police development levy started in, though it was signed into law in 21st of June 2019. So the purpose of this police development levy is to use the fund to train police personnel to procure security machine and equipment. But it was signed into law in 2019. But Finance Act 2021, which commenced in January 2022, was the one that introduced it. That means police development levy started in year of assessment 2022, 2023, 2024. Year of assessment 2025 will be the 4th year we have started charging police development levy. It is also collected by FRS, and it is charged at the rate, just a little rate. The rate is too small. It's less than 1%. Look at the rate, 0.005% of your net profit as a company. You pay police development levy. 0.005% of your net profit as a company. That is the rate we are going to pay as police development levy. It is also collected, administered by FRS. At the end of the day, once FRS collects this police development levy, they will remit it to Nigeria Police Force so that they can use it to train, procure security machine. So we started implementation of police development levy in year 2022, year of assessment. That is the first year. Second year, 2023. Third year, 2024. This 2025 year of assessment will make it the 4th year they have started charging police development levy. It's a direct tax too. Hope you can hear me clearly. Hello?
Yes, sir. Yes, sir.
Okay. So that is on police development. So we are under direct tax. Under the direct tax, I've mentioned personal income tax, number 1. Number 2, company income tax. This company income tax, what is the rate of company income? Who can tell me the rate of company income tax?
30%, sir.
30%. What is the rate? 30%. Ladies and gentlemen, according to Finance Act 2020, the rate of company income tax will depend on the turnover. If your turnover is more than 100 million in a year as a company, you are going to pay company income tax at the rate of how many percent?
30%.
30%. But if your turnover is between more than 25 million to 100 million, what is your rate of company income tax?
20%.
What if your
20%.
turnover is less than 25 million? What is the rate of your company income tax?
0%. 0%.
0%. That means you are a small company. A small company that has a turnover less than 25 million will not pay company income tax. Ladies and gentlemen, all this rate I'm talking to you, at any point in time, it will change. Do you agree with me? Hello?
Yes, sir.
At any point in time, all this rate will change by this year. Who agree with me? Because of what? Because of tax reform. All this rate, it has been changed in the tax reform. Do you agree with me? If you read the tax reform very well, hello?
We are with you, sir.
Yes, all these rates, both personal income tax, company income tax rate, value-added tax rate, it has been changed already under the tax reform. But they are yet to sign the tax reform into law. As at present, this is the rate we are still using. So for this May diet, for ICANN cannot test anything on tax reform because tax reform is still on deliberation. They are still deliberating it. Some evil spirit are still holding it back. Abi, do you agree with me? Do you agree with me?
Yes, sir.
So,
Yes, sir.
for this our May diet, I will advise we don't need tax reform now. Tax reform is not yet to be included in the ICANN syllabus. ICANN to wait. They want to review the advanced tax. They thought we'll review it by next year. Ideal thing is that tax reform supposed to have been signed into law last year, but because of a lot of issue, a lot of different stakeholders, they are dragging it back. Some people think that tax reform will not favor them. That is the reason why it's still being on hold. So by virtue of that, we don't need anything on tax reform in this our ICANN May exam now. By November diet, all this rate will change, I believe. Because if you read tax reform very well, company income tax rate has changed totally. A lot of things have changed. Tax reform is a new dimension in tax. All what we have known before, we have to delete it once we sign tax reform. Once they sign tax reform into law. Tax is dynamic. It's not static. Tax is different from any other subject that they will be using formula. This is not formula, this is law. So as a small company, you are not expected to pay company income tax. You are not expected to pay education tax as a small company. The only tax a small company will pay is called police development levy. They will pay police development levy. That means in a year, if a company turnover is less than 25 million, in that year that their turnover is less than 25 million, they will not pay company income tax, they will not pay education tax, they will only pay police development levy. That is it on direct tax. Now, let's go to indirect tax. We are under classification according to incident. When we classify tax according to incident, we say there are two types of tax, direct tax and indirect tax. Direct tax, under the direct tax, we have personal income tax, company income tax, capital gain tax, petroleum profit tax, which is hydrocarbon tax, education tax, technology tax. Now, indirect tax. Indirect tax, there are those taxes imposed on goods and services. And indirect tax normally shift from one person to another. And indirect tax is borne by the final consumer. Type of indirect tax. Number one type of indirect tax is custom duties. Custom duties. Custom duty, there are those duties imposed on imported goods. Some selected imported goods, they pay custom duties on them. And custom duty rate depends on the type of goods. We have excise duties too. There are some goods that we manufacture within the country. Custom also collect duties on them. Such kind of duty collected on goods manufactured within Nigeria is called excise duties. Aside that, we have another type, value-added tax. Value-added tax is charged on goods and services consumed, and it is paid by the final consumer. It is at the rate of how many percent? 7.5%. According to tax reform, what is the rate of value-added tax? As stated in the tax reform. Who have read the tax reform? What is the rate of value-added tax?
10%.
The rate of value-added tax depends on the year. It will start from 10%. Gradually, it will increase to, I think, 12%. At the end of the day, like 3 years, it's still coming to how many percent? 15%. You are right. So as a good student too, that tax reform, you need to read it for you to understand what is going on in the economy. Before, value-added tax rate was 5%. It was increased to 7.5% as from the year 2020, which Finance Act 2019 increased it. Another type of indirect tax is stamp duties. Stamp duties. Stamp duties. What is stamp duty? They are those duties paid on a document or transaction to make it a legal binding. Example of stamp duty is electronic transfer levy, 50-50 naira charged on a transaction above 10,000 naira. It's a stamp duty. It's an indirect tax because it is borne by the final consumer. Please try to mute your audio. That person should mute his or her audio. So this is the summary of tax. I've made the summary of different types of tax. Who collect the tax? What type of income subjected to tax on them? You can read more about it. Principles of taxation. Principles of taxation. Principles of taxation is otherwise called canon of taxation. Canon of taxation. They are the attribute of a good tax system. Principle of taxation is otherwise called canon of taxation. They are the attribute of a good tax system. They are the canon of taxation. They are the attribute of a good tax system. Number one principle of taxation is principles of convenience. Under the principles of convenience, these principles say that a good tax system must be based on ability to pay. That means a good tax system must be convenient to the taxpayer. Tax should not be inconvenience to the taxpayer. It should be convenient. That means the time of tax collection, the timing, and the method of tax collection should be convenient to the taxpayer. How? Timing of tax collection should be convenient. Tax is collected at the end of the year. not at the beginning of the year. At the end of every year, collect tax. Example, personal income tax. It is after employee have collect salary. The following month, it is then the State Board of Internal Revenue will ask you to come and pay personal income tax, pay your staff salary. That means the timing is convenient to the taxpayer. Secondly, the method of payment should be convenient to the taxpayer. How will method of payment convenient to taxpayer? If taxpayer want to pay tax, they should not go through a lot of stress. In the 2015 downward, if you want to go and pay any type of tax, you have to go to bank. You go to bank. When you go to bank, some bank, they will even say we are not collecting tax. Go to this one of our branch in another place. They are the one managing tax. If you go there again, that one will say there is no network. Taxpayer will undergo a lot of stress because they want to pay tax. That means it's not convenient. But FRS of recent, they introduced a software that makes tax to be convenient to the taxpayer. Who can mention the software? There is a tax software that has made tax to be convenient to taxpayer, introduced by FRS. Who can mention it? Oh yeah, now. Hello. You have heard of Tax Promas? Tax Promas is a software introduced by FRS for seamless collection, processing, filing of tax return. Right now, if I want to pay any type of tax to FRS, I don't need to go to bank. I'll just log into the company Tax Promas profile. From that profile, it will take me to remitter. From remitter, I pay my tax and they give me receipt. That is conveniency. Principles of simplicity. Number one, principles of taxation. Principles of simplicity. A good tax system must not be complex. It should be simple to understand, straightforward and simple. Tax should be written in the language understood by the taxpayer. Tax should be written in the language understood. Tax should be written in the language understood by the taxpayer. In tax, we don't need big grammar. We don't need big concepts. No. Write it in the language understood by the taxpayer. In adherence to the principles of simplicity, if FRS want to make publication, they have to make the publication in English, they will make it in Yoruba, they will make it in Hausa language, they will also make it in Igbo language, so that people will not say they are ignorant of the tax law. Some people can say they don't hear English. If you don't hear English, you can hear Yoruba, or you hear Igbo, or you hear Hausa. Do you understand? Do you understand? So we are on principles of taxation. Let's look at that before we close for today. Principles of economy is saying that the cost of cost administration, the cost incurred in the cost of tax collection should not be more than actual tax collected. Tax should be on cost benefit analysis. The benefit government will receive from tax collection should outweigh the cost incurred. That means what in a year, what government will realize from tax collection should be more than the amount of the salaries and wages of the tax administrator, the cost of maintenance of the tax office. They should not spend much money while they do not realize much revenue. That is principles of economy. Another principle that we want to look at is principles of equity. Equity means fairness, unbiased. Principle of equity is saying that every taxpayer should be treated in an equal manner and fairness. There should not be biased treatment of taxpayer. There should not be sentiments against any taxpayer because of his tribe, his culture, or his religion. As a Christian or as a Muslim, don't let us bring it into tax. Once you are a taxpayer, pay the same tax. Don't say because this one is a Christian, you should pay higher tax than Muslim. Don't say because this one is a Northerner, you should pay higher tax than Southerner.